Something has changed inside Berkshire Hathaway, something the market still refuses to see. For the first time in decades, Warren Buffett is moving in a way that feels less like routine strategy and more like preparation for a moment of upheaval. His reports no longer read like the steady, predictable documents investors grew comfortable with. They read like warnings. The cash is piling up, the acquisitions have stopped, and once untouchable holdings are quietly being dismantled. Buffett is repositioning Berkshire for conditions that have not arrived yet, but he clearly believes they will. And when Buffett prepares in silence, it usually means the storm is already on the horizon. In recent years, the quarterly reports of Berkshire Hathaway have stopped being routine financial documents and turned into something much more unsettling. For decades, these reports reflected stability, predictability, and Buffett's signature long-term discipline. But now the numbers look different, the structure looks different, and the decisions behind them suggest that Warren Buffett is quietly preparing for a moment the market has not yet understood. Analysts who once skimmed his filings now study them line by line, because something in Berkshire's behavior has clearly shifted. The most striking signal is the unprecedented rise in Berkshire's cash reserves. Buffett has always insisted that holding excessive cash is unproductive, a missed opportunity. Yet today Berkshire is sitting on record levels of liquidity, larger than at any previous point in its history. Buffett is not simply being cautious. This is a deliberate accumulation of dry powder, a war chest built for a moment when markets lose balance and assets become irrationally cheap. The question that now hangs over Wall Street is simple: what exactly is he waiting for? Changes in the composition of the portfolio reveal even more. Buffett has begun reducing positions in companies he once described as practically untouchable. Long-term holdings that delivered years of consistent returns are being trimmed or closed without any public explanation. These are not impulsive moves, nor reactions to temporary volatility. They resemble a slow, methodical reallocation made in anticipation of a fundamental shift in the economic landscape, a shift Buffett sees long before the crowd. Even more surprising is Buffett's retreat from sectors that dominated his strategy for an entire decade. For years, he increased exposure to major American tech companies, calling them the new pillars of the economy. Now he is gradually scaling back, redirecting capital into industries that historically survived downturns or gained strength during financial disruptions. This is not fear, it is positioning. Buffett is aligning Berkshire with conditions that have not yet arrived, but that he believes are approaching with certainty. Another subtle but important signal is the near-complete pause in large acquisitions. Buffett built much of his empire through buying entire companies. Today he is holding back, even with tens of billions of idle cash on the balance sheet. He has hinted many times that he will not buy at inflated prices. If he is waiting, it means he believes the real opportunities will emerge only after the market resets itself through a major correction. Taken together, these decisions form a pattern that cannot be ignored. Buffett is not acting like an investor preparing for routine turbulence. He is acting like someone who anticipates a turning point similar to 2000, 2008, or 2020. Every time he accumulated cash and slowed down acquisitions, a crisis followed. The market still celebrates new highs, analysts debate soft landings, but Buffett has already shifted his strategy. And historically, when Buffett changes direction quietly, the world discovers the reason only years later. Buffett has entered waiting mode, a rare signal that has appeared only before major market breakdowns. Warren Buffett is famous for many things, but above all for his consistency. He rarely changes his philosophy, rarely reacts to noise, and almost never makes decisions based on short-term movements. Yet throughout his career, there have been several rare moments when he shifted into what can only be described as waiting mode. Each time this happened, it signaled that Buffett saw something ahead long before the market did. And every time, those signals proved to be warnings of major economic turning points. To understand his current behavior, we must look back at the patterns that defined his strategy during previous crises. The late 1990s were a perfect example. While the world celebrated the rise of tech stocks, Buffett quietly refused to participate. He reduced exposure to overpriced sectors and accumulated cash, insisting that valuations made no sense. At the time, he was mocked for being out of touch. But when the dot-com bubble collapsed, his caution was proven not only reasonable but visionary. He waited, the market fell apart, and he deployed capital at discounts no one could have imagined during the euphoria. A similar pattern emerged in the years leading up to the 2008 financial crisis. Buffett once again slowed his acquisitions and began building liquidity. He saw signs of instability long before they became obvious. When the global financial system cracked, he stepped in with massive deals that saved companies like Goldman Sachs and General Electric, earning returns that ordinary investors could only dream of. His strategy was not panic, it was patience. He was waiting for the moment when fear would create opportunity. Even in 2020, during the early months of the pandemic, Buffett repeated this approach. He sold airline stocks before the sector collapsed and stopped new investments, something he had not done in years. Critics questioned his caution, but within months the market experienced one of the fastest and most violent disruptions in modern history. Again, Buffett's waiting mode aligned precisely with the onset of chaos. These patterns share several traits. First, Buffett becomes unusually conservative only when he sees a structural imbalance, not temporary volatility. Second, he increases cash not because he fears loss, but because he anticipates the opportunity that only deep declines provide. Third, he withdraws from sectors that are over-celebrated or mispriced, even if they produced strong returns previously. And finally, he stops making big acquisitions when prices no longer reflect true economic value. Now these same signals are appearing again. Rising cash levels, strategic retreats from certain industries, and pauses in major deals all mirror the behavior he displayed before the last three crises. The market may interpret this as randomness or caution, but Buffett's history says otherwise. When he waits, he is not uncertain. He is confident that the real move is still ahead. The reason this moment feels different is that the scale of his current waiting mode is larger than anything previously recorded. Buffett is preparing for something bigger, something he believes will realign markets in a way similar to previous economic resets. And if his past behavior is any indication, he is waiting for the exact year when opportunity and chaos meet. Many analysts believe that year may be 2026. One of the most revealing clues to Warren Buffett's long-term strategy is not found in the companies he buys, but in the cash he refuses to deploy. Throughout his career, Buffett has repeatedly said that cash, by itself, is not an investment. It produces no earnings, no growth, no compounding. Yet today, Berkshire Hathaway is holding the largest cash pile in its entire history, a mountain of liquidity so vast that it has become impossible for analysts to ignore. And this raises the question that drives the entire market. Why would a man who hates idle money choose to sit on a record-breaking reserve? To understand the meaning of this cash buildup, we need to look beyond the numbers and examine Buffett's mentality. He has always used cash as a strategic weapon, not an asset. When markets are stable, his cash position remains modest. When markets drift into irrationality, he allows cash to grow. And when fear hits, he uses that cash to make the kinds of deals that only appear during moments of panic. In other words, when Buffett accumulates this much liquidity, it is never accidental. It is a calculated preparation for a future moment of extreme mispricing. What makes the current situation exceptional is the scale of his reserves. Buffett is not sitting on a few extra billions as a safety measure. He is sitting on amounts large enough to buy entire corporations outright. This level of liquidity suggests that Buffett expects a period when valuable companies will be forced to sell assets at deep discounts, when credit becomes scarce, and when cash becomes the most powerful bargaining tool in the financial world. Historically, such environments occur only during severe market dislocations. Another sign that this cash accumulation is not random lies in the timing. Buffett began increasing reserves precisely as market valuations reached their highest levels in years. Price-to-earnings ratios expanded far beyond historical averages, speculative sectors grew without fundamentals, and debt across the economy approached dangerous levels. Buffett saw these conditions as unsustainable. For him, overpriced markets are not opportunities, they are warnings. By building cash, he is positioning Berkshire to take advantage of a correction that has not yet arrived but appears increasingly likely. There is also a deeper structural reason behind his decision. Buffett does not trust environments where money is cheap, debt is plentiful, and investors chase growth at any price. Such conditions often end abruptly, leaving markets exposed and vulnerable. Holding significant liquidity allows him to step in when everyone else is forced to retreat. It gives him leverage, power, and the ability to dictate terms and transactions. In crises, cash is not simply cash. It is control. This brings us to the question of why analysts link Buffett's behavior specifically to the coming years, and why many believe he is preparing for 2026. Some of the macro indicators he follows closely are already flashing signs of stress. Consumer debt surging beyond income growth, corporate borrowing at record highs, rising risk in commercial real estate, and the ongoing struggle of banks to maintain profitability in a high-rate environment. Buffett is not reacting to headlines. He is reacting to structural imbalances that take time to unfold. Every time Buffett has accumulated large cash reserves, a major opportunity followed within a few years. He is patient, but not endlessly. When he collects this much liquidity, it means he is waiting for a very specific moment when fear outweighs optimism and prices fall to levels that reward bold decisions. His current cash pile hints that such a moment is not decades away, but rather approaching in the near future. Taken together, these signals suggest one thing. Buffett is not hoarding cash because he is uncertain. He is hoarding cash because he is absolutely sure that the environment ahead will deliver extraordinary opportunities, and he intends to be ready the moment the market breaks. Warren Buffett has never claimed to predict the future, yet time and time again he reacts to economic danger long before it becomes visible to the broader market. His strength is not forecasting, but pattern recognition. He watches fundamental indicators that most investors ignore, and when these indicators begin to shift, he adjusts Berkshire's strategy quietly and deliberately. The current global environment contains several risks that Buffett has likely identified, risks that explain why he is preparing for a major reset rather than a mild slowdown. One of the most significant threats is the growing structural weakness in the United States debt system. Government debt has surpassed levels once considered unimaginable, and the cost of servicing that debt has exploded due to higher interest rates. For decades, the U.S. could borrow cheaply, but that era is ending. Rising debt costs create pressure on every part of the system, from government spending to the stability of the dollar. Buffett knows that when debt becomes heavier than growth, the financial system becomes fragile. Another critical risk is the corporate debt bubble. American companies have borrowed aggressively over the past decade, taking advantage of near-zero interest rates. They refinanced old loans, issued new ones, expanded buyback programs, and inflated valuations without increasing real productivity. Now, as those loans mature, refinancing will occur in a high-rate environment. Many firms will not be able to survive this transition. Buffett has witnessed similar debt cycles before, and he understands how violently they unwind. The banking sector presents its own vulnerabilities. High rates have eroded the value of long-duration assets held by banks, creating unrealized losses that some institutions cannot absorb. Several regional banks have already collapsed, and many others are quietly struggling. Buffett pays close attention to banks, not because he expects them all to fail, but because he knows that banking stress spreads unpredictably. When confidence weakens, liquidity evaporates. And when liquidity evaporates, markets follow. Another looming risk Buffett sees is the disconnect between asset prices and economic reality. In many sectors, valuations have soared beyond what earnings justify. This is especially true in commercial real estate, where remote work and shifting demand have left countless office buildings underoccupied and overvalued. A massive wave of refinancing is approaching, and many properties will not meet the revenue requirements needed to secure new loans. Buffett understands the chain reaction this can trigger throughout the financial system. He also pays attention to global instability. Geopolitical tensions are rising, supply chains remain fragile, and key regions of the world are entering periods of political uncertainty. These conditions make markets more sensitive to shocks. Even minor disruptions can produce extreme volatility when underlying systems are already stressed. Buffett does not base decisions on news cycles, but on structural risks that accumulate quietly until they break. Inflation remains another unresolved danger. Even though official numbers fluctuate, the underlying forces keeping prices elevated have not disappeared. Supply constraints, rising labor costs, and global competition for resources continue to push prices up. High inflation pressures central banks to maintain higher rates longer than markets expect, prolonging economic strain. Buffett knows this dynamic well. Inflation destroys purchasing power, distorts valuations, and forces companies to operate under uncertain conditions. Taken together, these threats create an environment far more fragile than the average investor realizes. Buffett is not reacting to a single problem, but to a convergence of many. Each threat alone is manageable. Together, they form a landscape where a major correction becomes not a possibility, but an eventuality. And while the market hopes for a soft landing, Buffett is positioning Berkshire for the scenario he sees as far more realistic, a sharp adjustment that will create once-in-a-decade opportunities for anyone holding cash and patience. If there is one thing that defines Warren Buffett more than patience, it is precision. He does not simply wait for crises. He prepares for them with a clear map in mind. Every major downturn in the past has allowed Buffett to make transformative acquisitions, deals that reshaped Berkshire Hathaway for decades. The scale of his current liquidity suggests that he is preparing for another such moment. And if analysts are correct that this moment may arrive around 2026, then understanding what Buffett intends to buy becomes critical to understanding his entire strategy. Historically, Buffett has moved aggressively into sectors that become undervalued during market distress. At the top of that list are banks and financial institutions. During the 2008 crisis, he secured deals with terms so favorable that they produced billions in profit within just a few years. Banks are essential to the economy, and when panic hits, even strong banks trade at deep discounts. Buffett knows that well-run financial institutions become gold mines when acquired during periods of fear. If a major correction arrives, this sector will likely be one of his first targets. Insurance is another area Buffett may double down on. Berkshire's insurance operations are already among the strongest in the world, and acquiring distressed competitors during an economic downturn would give Buffett even more pricing power and access to massive cash flows through insurance float. Insurance companies often become temporarily mispriced during crises because short-term losses overshadow long-term profitability. For Buffett, that is opportunity, not danger. Energy and infrastructure are also high on the list of potential targets. Buffett has always favored sectors that provide essential services regardless of market conditions. Energy companies with strong cash flow, utilities with regulated revenue, and infrastructure assets with long-term contracts all fit his investment philosophy. During recessions, these businesses often trade below intrinsic value, even though their long-term fundamentals remain strong. Buffett has shown repeatedly that he prefers predictable cash-generating assets over speculative growth stories, especially in turbulent periods. A less obvious but equally important sector is industrials. Companies involved in transportation, manufacturing, logistics, and materials often suffer sharp declines during economic slowdowns as demand temporarily contracts. But these are the same companies that rebound strongly when recovery begins. Buffett has long understood the power of owning businesses tied to the backbone of the real economy. If valuations collapse, he will not hesitate to acquire major industrial players at fractions of their fair value. Technology may also play a surprising role in Buffett's future strategy. Although he has reduced exposure to some tech companies, this does not mean he is against investing in the sector. It simply means current prices do not justify investment. If a broad correction sends high-quality tech firms to reasonable valuations, Buffett could seize the opportunity. He has already demonstrated this with his position in Apple, one of the most successful investments in Berkshire's history. If another tech giant becomes undervalued, Buffett will be prepared. There is also the possibility of something larger, a mega acquisition. With such immense levels of cash, Buffett could buy an entire Fortune 50 company outright. He has expressed interest in large-scale deals for years, but prices have been too high. A major market reset could finally bring valuations into a range where a historic acquisition becomes feasible. Such a move would define the next era of Berkshire Hathaway. Ultimately, Buffett's strategy for 2026 is not built on predicting exact events. It is built on being ready. He knows that crises create windows during which mispriced assets become available for only a short time. His record shows that when others panic, he deploys capital with unmatched speed and confidence. This is why he is building liquidity, why he is stepping back from overpriced markets, and why he is preparing for a moment that the rest of the world still refuses to believe is coming. When Warren Buffett shifts his strategy, the world pays attention. Not because he makes loud predictions or dramatic statements, but because he does the opposite. He moves quietly, patiently, and with a level of discipline that almost no one else can match. His behavior today contains a message far more valuable than any market forecast. For ordinary investors, understanding this message may be the most important financial lesson of the decade. The first lesson is simple but extremely difficult to apply. Buffett prepares long before danger becomes visible. Most investors react only when markets begin to fall, when headlines become frightening, or when losses start to accumulate. Buffett does not wait for confirmation. He recognizes patterns early, observes structural weaknesses, and adjusts calmly while everyone else is still celebrating new market highs. This approach requires emotional distance, the ability to ignore the noise, and the willingness to act against popular sentiment, qualities most investors struggle to develop. The second lesson is the meaning of patience. Buffett often repeats that opportunities come rarely, but when they come, the key is to act decisively. To do that, an investor must have reserves, whether cash or liquid assets that can be deployed at the right time. The average investor often stays fully invested at all times, fearing that holding cash is a wasted opportunity. But Buffett demonstrates that cash is not wasteful, it is potential. It is stored optionality, the power to act when circumstances change. His record shows that a large portion of his greatest returns came not from constant activity, but from long periods of waiting followed by one bold move. Another lesson involves emotional resilience. Crises are painful and chaotic, but they are also moments of extreme mispricing. When fear dominates markets, rational investors suddenly find themselves surrounded by opportunities that were unimaginable only months before. Yet most people cannot see them because they are consumed by panic. Buffett's strategy teaches that during times of crisis, clarity is more valuable than capital. The investor who remains calm while others panic can turn turmoil into advantage. A fourth lesson is the importance of understanding true value. Buffett does not buy companies because they are popular or trending. He buys them because he understands their long-term ability to generate earnings. When a crisis hits, many investors focus on price movement rather than on the underlying value of a business. Buffett does the opposite. He studies fundamentals, waits for the price to fall below the intrinsic value, and then buys aggressively. For ordinary investors, this means resisting the urge to follow momentum and instead learning how to evaluate companies based on real financial strength. Another insight hidden in Buffett's actions is the recognition that markets move in cycles, not straight lines. Periods of expansion lead to excess. Excess leads to imbalance, and imbalance leads to correction. Buffett accepts this reality instead of resisting it. He does not try to force the market to behave a certain way. He positions himself so that any cycle, whether positive or negative, benefits his long-term strategy. Most investors lose money because they fight cycles, trying to predict when they will end. Buffett, in contrast, embraces cycles and prepares for their consequences. A final and perhaps the most important lesson is that success in investing is not about intelligence, but about temperament. Buffett has said many times that emotional stability is the real edge in markets. The ability to avoid greed during booms and fear during downturns is what separates disciplined investors from speculative gamblers. His current posture of caution is not born from pessimism, but from confidence in his own process. He prepares because preparation works. He waits because waiting works. He holds cash because he knows exactly what to do with it when the moment arrives. For ordinary investors, the message is clear. You cannot control the market, but you can control your behavior. You cannot predict the next crisis, but you can prepare for one. You cannot eliminate risk, but you can decide how to respond to it. Buffett's actions today are a blueprint for weathering uncertainty, navigating volatility, and emerging stronger after turmoil. If his preparations are pointing to 2026, then the real lesson is not fear. It is opportunity. Crises are not the end of the story. For those who are ready, they are the beginning of a new one.